Okay, so let's dive into this mountain of real estate loan documents. We've got a big snack here. I bet you're super excited to finally close on that dream home, right? Or maybe you're refinancing, but then bam, you get hit with this huge pile of paperwork.
Yeah, it's true. These documents are really important, but they can definitely be a little overwhelming.
I bet. So in today's deep dive, we're going to break down all the essential parts of these documents step by step so you can feel totally confident at the closing table. And to help us with that, we have Eddie Montes Travis, experienced real estate loan officer.
And I'm Marylyn Lee Trotter, a certified mobile notary signing agent. I see firsthand how confusing these documents can be for people, so I'm here to help you navigate them.
Fantastic. So let's pretend we're sitting down with you, Marylyn, at the closing. The very first page is a confirmation cover sheet.
Yep, and this is where we start. It's like a roadmap for the whole loan package. We need to make sure everything on this page is accurate.
Okay. So, Marylyn, what are the key things you're checking on that cover sheet with the borrower?
First up is the loan number. This is super important for tracking everything related to your loan, so it needs to match up with what you've been given before.
So that's a unique ID for this whole process. What else?
Next, we're checking the borrower and property information names, addresses, all those details. Every single thing needs to be absolutely correct. Any little errors here could cause big problems down the line.
Accuracy is key here. Sounds like it's time to grab those reading glasses.
Absolutely. We'll also check the loan purpose. Is this a purchase, a refinance, or something else? This has got to be clearly stated.
Right. And then, of course, the big day, the disbursement date, that's when the loan funds are actually sent out.
Right. And you might see some codes on the cover sheet, too, like program code and channel. These are mostly for the lender's internal tracking, but it's good to understand what they mean.
Got it. So, Marylyn, that first page is kind of like a sniff test, making sure all the basics are right before we dive into the rest of the paperwork.
Exactly. Once we're good with the cover sheet, we move on to the closing instructions. This section is like the lender's playbook for me, the closing agent.
Interesting. So it lays out exactly how the closing should go.
Yep. And I have to follow these instructions to the letter really carefully. But for you, the borrower, it's a good sign that the lender is serious about making this a smooth process.
Good to know. I'm seeing here that the lender has to give you, the borrower, all the final closing disclosures before you sign. That sounds pretty important.
Oh, it is. No surprise at the last minute. You have time to review those final numbers and all the terms before you commit to anything.
That's good. I also see something about recording fees. The closing agent has to send an invoice to the lender for those fees within 5 business days.
Yeah, transparency is really important here. Helps keep everyone accountable and make sure you're aware of all the costs involved.
Okay, moving on, we get to the borrower information section. What's happening here, Marylyn?
This is where we double-check all your personal info, full names of everyone borrowing, how ownership is held, the mailing address, all the lender's info, and, of course, the property address, county, and type of property.
So pretty basic stuff, but obviously really important to get it right.
Oh, absolutely. Even small errors can cause delays or complications later on.
Okay, let's get to the good stuff. The loan terms. This is where it gets real, right?
It is. This section outlines all the specific details of your mortgage, and it's super important to understand each part.
Okay, break it down for us. What are the key things we need to know here?
All right, first, the loan amount. This is how much you're borrowing. And if you're buying, the sale price will be listed here too. Then you've got the term. That's the length of the loan in months, usually 15 or 30 years.
So that's how long I'll be making those monthly payments. What else is there?
Then there's the interest rate. Of course, this is the percentage you're being charged on the loan amount. It can be fixed, which means it stays the same throughout the loan, or it can be adjustable, so it can fluctuate.
Oh, yeah. There's a big difference there. I also see a product description, so you know exactly what type of mortgage it is, conventional, FHA, VA, that kind of thing.
Right. And then you've got your first payment due date, so mark those calendars. We'll also look at whether you have impounds included. That means your property taxes and insurance are rolled into your monthly payment.
So you know exactly how much to budget each month. And finally, this section will say if you're getting any cash back at closing, some loans have that, which can be nice for those closing costs.
Exactly. So as you can see, there's a lot of essential info packed into this loan terms section.
Totally. Now let's talk about a topic that can be a little confusing. Title insurance requirements. Marylyn, can you explain what title insurance is and why it matters so much?
Sure. Title insurance basically protects you from any hidden claims or lands that might pop up on the property's title, things that even a thorough title search might miss.
Stuff like insurance for your ownership rights to the property.
Right. This section will tell you whose name on the policy, which should be the same as on the deed. It'll also list any required endorsements, which give you extra protection in specific situations, like boundary disputes.
Oh, interesting. So it's kind of like customizing the insurance to fit your property.
Yeah, you could say that.
Yeah.
We'll also go over anything that title insurance is subject to, things like existing lations or claims that will stay on the title even after you buy the property.
Okay, good to know. I see section here for additional closing instructions. What kind of stuff is usually in there?
Well, these can be all over the document. It's easy to miss them, but they can be really important. For example, a common instruction is making sure the legal description in the title policy matches the one in the deed of trust. This guarantees everyone's talking about the same exact property.
No room for error there.
Nope. Another thing you often see is that when the deed of trust is recorded, the title company agrees to issue the policy following the instructions. It's like a final confirmation that everyone's on the same page.
So even though those extra instructions might seem small, they're really important for making sure everything's legally sound.
Absolutely. They help protect you, the buyer.
Yeah.
And now we come to the consumer requests section.
Now this sounds like a part where you actually have some power.
You do. This is a reminder that you can ask questions and even request changes to the documents before you sign anything. If something isn't clear or if you're worried about something, this is the time to speak up. It even lists your contact info so you know who to call.
So don't be shy. It's always better to get those questions answered now than to have regrets later.
Right. And if I, the closing agent, am not also the title insurance company, there will be a closing protection letter in here. This protects you in case something goes wrong during closing, like if the closing agent makes a mistake.
So it's like an extra layer of insurance just for the closing itself.
Yep. It's all about peace of mind for you. Okay, next is the enclosed loan documents section. Looks like a pretty long list.
I bet. Do we need to go through every single one right now?
No, not to worry. Each one has a purpose, and we'll go through them in detail at your closing. We'll look at things like the addendum to those closing instructions, the closing disclosure, the note, the security instrument, the notice of right to cancel, and a bunch more.
Okay, good to know what's coming. But I don't have to memorize everything right now.
Exactly. Just know that you'll have time to look at each document and ask any questions before you sign anything.
Okay, that's reassuring. Now let's talk about the conditions to be satisfied prior to disbursement. This sounds pretty serious.
It is. This part tells us what has to happen before the lender can actually release the funds. It's all about making sure everything is in order.
Like a final checklist before the money changes hands?
Yeah.
What kind of conditions are we talking about here, Marylyn?
First off, all those required documents have to be signed by every borrower. That's a given. The lender also needs to receive the final closing disclosure that we talked about earlier.
Makes sense. Got to have those confirmations.
You might also see something about private transfer fees. Sometimes homeowners associations or developers charge these fees when a property is sold, and the lender might require that those fees aren't added to your closing disclosure.
Interesting. So that protects you from any last-minute surprises.
Yep. Another key condition is following that 3-day right of rescission if it applies to your loan. This gives you, the borrower, 3 business days after you sign to cancel the loan, no penalty.
That's a big one, and we'll definitely come back to that later. So basically, this conditions section is making sure all the T's are crossed and the I's are dotted before the loan is actually finalized.
Exactly. It's a safeguard to protect both you and the lender. Speaking of that right to cancel.
Right, we have a whole separate document for that. Right to cancel requirements.
Yep. This one's important enough to have its own document. As we mentioned, this applies to refinances and some other loans, but not if you're buying a place. It gives you 3 business days to change your mind after you've signed, and there's absolutely no penalty for canceling during that time.
Wow, that's good to know. No buyer's remorse here.
Exactly. One crucial detail to remember, though, is that the cancellation date is based on the document date, not the day you actually sign. So, say you sign on a Friday, but the document is dated Wednesday. Your right to cancel extends until Monday.
Okay, so pay attention to that date. It could be a bit tricky. Now let's move on to the big one, the closing disclosure.
This document is your final breakdown of all those loan terms and all the closing costs. It's divided into a few sections, and we'll go through each one carefully.
Okay, I'm ready. What's the first thing we'll see?
First up is projected payments. This shows you what your estimated monthly payments will be: principal, interest, taxes, insurance, and anything else that's escrowed.
So this is where I start planning my budget and make sure I can comfortably handle those payments every month.
Exactly. It's important to note that these are estimates. They might change a bit over time, especially if you have an adjustable rate mortgage or if things like property taxes or insurance premiums go up.
Makes sense, but at least it gives me a starting point.
Then we have costs at closing. This is a super detailed list of all those fees that come with closing the loan, things like lender fees, title charges, recording fees, prepaid interest, homeowners insurance premiums, and any other upfront costs.
So another check for accuracy and transparency.
Right. And lastly, the closing disclosure has the cash to close section. This is the big number, the total amount you'll need to bring to the closing table.
Got it. So no surprises when it comes time to pay.
Exactly. Now, in addition to those sections, the closing disclosure has a bunch of important disclosures that give you more information about the loan.
Okay, let's dive into those. What kind of disclosures are we talking about here?
Well, one is about loan assumptions. This basically tells you whether you can transfer the loan to someone else if you decide to sell your property later on.
Oh, so that's how I know if I have that option.
Right. Then there's the demand feature. This outlines whether the lender can demand that you repay the entire loan early under certain circumstances.
Definitely something to watch out for. What else should I be aware of?
We'll also go over the info about late payments, the grace period, and any penalties. And another important disclosure is about negative amortization. This explains whether your loan balance could actually increase even if you're making your regular payments on time.
Wait, my loan balance could actually go up. How does that happen?
Basically, if your monthly payment isn't covering all the interest, the unpaid interest gets added to your principal balance and it grows. The good news is the disclosure will clearly state whether your loan has this feature.
Okay, good to be aware of. What other disclosures are there?
We'll look at info about partial payments. That means whether you have the option to make smaller payments than the full amount. And we'll go over those disclosures about your escrow account, which tell you how those property taxes and insurance premiums are handled.
So all these disclosures are giving me a full picture of the loan terms, the good, and the, well, maybe not so good.
Exactly. It's all about transparency so you can make an informed decision. Now, let's move on to the loan calculations section.
Okay, time to crunch some numbers. What are the main calculations I'll see here?
Okay, first, we have the total of payments. This is the total you'll pay over the entire life of the loan. Principal, interest, and any mortgage insurance premiums. It's a big number, but it's important to understand the full cost of borrowing.
Right. Got to see the big picture. What else?
There's the finance charge, the total cost of borrowing expressed in dollars. This is all the interest you'll pay over the loan's life, plus any lender fees or other charges.
So basically the total cost of the loan itself, not including the principal I'm borrowing.
Right. Then there's the amount financed. This is how much money you actually receive after they deduct any upfront charges. So if you're paying those closing costs out of pocket, the amount financed will be a little less than your total loan amount.
Got it. It's the net amount I'm actually getting. And finally, we have the APR, or annual percentage rate. Isn't that the same as the interest rate?
Not exactly. The APR includes not only the interest rate, but also any lender fees or other charges that come with the loan. It gives you a much more accurate picture of what the loan is really costing you.
Ah, I see. So the APR is a really important number to look at when I'm comparing loan offers.
Definitely. Okay, now we come to the addendum to closing disclosure and breakdown of credits. What's this for? This is like an extension of the closing disclosure. It's for any extra details that didn't fit on the main form. We might see things like seller credits or lender credits that are applied towards those closing costs.
So if I'm getting help with those costs, I'll see it listed here.
You got it. The section called Breakdown of Credits to Borrowers' Closing Costs will itemize all those contributions.
I like that. Transparency is good. What's next in our pile of documents?
Let's look at the promissory note. This is basically your formal promise to repay the loan, kind of like your IOU to the lender. It spells out all the key parts of the agreement: the loan amount, the interest rate when payments are due, and the maturity date, which is when the loan needs to be paid in full.
So this is the core document that legally binds me to the loan.
You got it. The promissory note will usually outline any prepayment penalties, too. Those are fees you might have to pay if you decide to pay the loan off early.
Good to know. Something to keep in mind.
And finally, this document will outline what happens if you default on the loan, meaning if you don't make those payments as you agreed.
So it lays out the risks.
Right. It's a serious legal document.
Now, up next, we have the deed of trust, or security instrument. This one sounds kind of scary. What exactly is it?
This document basically gives the lender a legal claim to your property if you don't repay the loan. Think of it like using the property as collateral.
So it's like a safety net for the lender.
Right. The deed of trust will have details about the property, who's borrowing, who's lending, and a third party called a trustee. The trustee holds the deed to your property for the lender. If you can't pay back the loan, the trustee can foreclose on the property and sell it.
Okay, so this is a pretty powerful document.
It is. It's really important for protecting the lender. But don't worry, we'll go over it carefully together at the closing.
Okay, good to know. And wait, is this the notice of right to cancel again?
It is. This document is super important, and it's good to see it a few times in the loan package. It's just a reminder that you can cancel the loan in those 3 business days after signing, and remember the document date is key for that cancellation period.
Okay, I get it. It's important. Now, let's talk about the documents that deal with payments and escrow. The payment letter and initial escrow account disclosure statement.
Right. The payment letter lays out the basics, like when your first payment is due, how long the grace period is if you're late, any late fees, payment options, and how to reach customer service.
So it's my guide to making those mortgage payments.
Exactly. And the initial escrow account disclosure statement only applies if you have an escrow account. This is where the lender holds money for your property taxes and insurance premiums. This statement gives you a breakdown of what's happening in your escrow account, like an estimate of the starting balance, the monthly payments you'll make, and when they anticipate paying out those taxes and insurance.
So it's like a projection of how my escrow account will work.
Exactly. Now, we've gone through a lot of documents. It can feel pretty overwhelming, but remember, I'll be there with you at the closing, going through every detail and answering any questions you might have.
That's good to know. It definitely helps to have a guide.
Absolutely. And in the next segment, we'll dive even deeper into some of the trickier situations you might encounter during closing. Things like dealing with errors in the documents or if something changes with the loan terms. So stay tuned.
All right, we're back. We're continuing our deep dive into those real estate loan documents. Last time, we got through a big chunk of that closing package. We started with the cover sheet and made it all the way to the amortization schedule.
Yep. We sure did. And now we're going to go even deeper, looking at some specific documents and some of those trickier situations you might run into when you're sitting at that closing table.
Okay, so, Marylyn, since you're the one walking people through all this, what are some of the things that tend to trip people up? What have you seen come up that can be a little confusing?
Well, one thing is when there are errors in the documents. Things get missed or things are wrong. It happens. No matter how careful everyone is, mistakes can slip through. Sometimes there's info missing or it's just plain wrong.
That makes sense. We're all human, right? But those errors, even little ones, could have big consequences when we're talking about important legal documents.
Right. Even small mistakes can cause delays or even make the documents invalid. That's why I always tell people to check every single detail, read everything carefully.
So what are some common errors that borrowers should watch out for?
One thing that happens a lot is a mismatch between what you agreed to for the loan terms and what's actually written down in the paperwork. Like maybe the interest rate is off or the closing costs are different from what you were originally told. Those kinds of things need to be fixed before you sign anything.
That sounds super frustrating. How do you usually handle it when something like that comes up?
Well, the first thing I do is let the lender and the borrower know right away. And then we all work together to fix it. The lender might have to give us updated documents, or sometimes the borrower has to provide some more info. The most important thing is that everyone is on the same page and comfortable with the final version before we move forward.
So good communication is key, making sure everyone's talking to each other.
Absolutely. Another common mistake is missing signatures or initials. It's easy to forget to sign a page, or maybe someone initials a change and forgets to sign the actual document. That can cause problems later on.
It's all about the details.
It really is. And sometimes it's not even a problem with the documents themselves. It's something with the info that the borrower gave. Maybe they accidentally put down the wrong info on their loan application, or they forgot to tell the lender something important.
Oh, that could definitely cause issues. What's the best thing to do in a situation like that?
And honesty is the best policy, right? Borrowers need to be truthful and thorough when they're filling out that application. And if anything changes before closing, tell the lender right away.
Right. It's always better to be upfront and address any issues early on. Now let's talk about occupancy agreements. What exactly are they, and why do lenders sometimes require them?
Well, an occupancy agreement is basically confirming how the borrower is going to use the property. Are they going to live there themselves, or would it be a rental property? A lot of lenders require these, especially for loans on primary residences, because the loan terms can be different if the property is going to be a rental.
Makes sense. A loan for a rental property might have different rules or a higher interest rate than a loan for a place you're going to live in.
Right. Occupancy agreements help the lender make sure that the borrower is using the loan for what they said they would and make sure they qualify for the correct terms. It also helps prevent people from trying to take advantage of the system.
Okay, so it's a way to keep everything transparent and protect both the lender and the borrower.
Exactly. Now, another document that helps ensure everything is accurate is the mortgagor's affidavit.
Can you refresh our memory on what that one is all about?
Sure. Basically, it's a sworn statement from the borrower confirming that everything they put down on their loan application is true and complete. Things like work history, income, assets, debts, credit history, all that.
So it's like putting it all in writing and saying, I swear this is all correct.
Yep. It makes it legally binding. And usually lenders will also require a Social Security number verification, which is just a quick check to confirm the borrower's identity. It helps prevent identity theft, too.
Good. That's an important step to have in there.
Mm.
Now, what about the tax information form? I know this one has to do with property taxes.
Right. This form gives the lender a good picture of the property's tax history and helps them figure out what the borrower's tax liability is going to be. It's also a way to make sure the property taxes are up to date.
Why is that so important? What happens if property taxes aren't paid?
Well, unpaid property taxes can actually become a lien on the property, which can complicate things, especially if the borrower ever wants to sell or refinance.
Oh, I see. So it's really important to stay on top of those property taxes.
Absolutely. Now, let's shift gears a bit and talk about something that's become more relevant in our digital world. The contact preferences form. This is where the borrower can say how they prefer to be contacted by the lender. Phone calls, emails, text messages, snail mail, that kind of thing.
Oh, that's a good one.
Yeah.
Everyone has their preferences.
Yeah.
No one wants to be bombarded with calls or emails if they don't want them.
Exactly. This form helps the lender respect those preferences and communicate in a way that works for everyone. Now, we already mentioned the Uniform Residential Loan Application, or 1003, but it's worth bringing up again.
Remind us what that one is all about.
Sure. It's the standard loan application form that most lenders use. It basically gathers all the necessary info about the borrower and the property. At closing, you'll get a copy of this form for your records, and it's a good idea to just give it a quick look over to make sure all the info is still correct.
Okay, so one final check for accuracy.
Exactly. Now, if you have a VA loan, you might see a few extra documents. One is called the VA Nearest Living Relative form, and it just asks for contact info for a family member who doesn't live with you, just in case of an emergency. It's just a safety precaution for the lender.
Okay, that makes sense. What else is there for VA loans?
You'll also get a V-counseling checklist for military home buyers. This covers some important things for military families to think about. Like, it points out that if you don't tell the lender about an upcoming PCS move, it could be considered bad faith.
Oh, wow. Why is that?
Well, if you move and can't make your payments, it could lead to a foreclosure.
Right. Transparency is so important, especially when it comes to moving.
Absolutely. The checklist also reminds borrowers that a VA loan isn't automatically assumable. That means you can't just transfer the loan to someone else without getting approval from the VA or the lender. And it emphasizes that the VA guarantees the loan, not the house itself.
So it's still important to get a good inspection and make sure the property's in good shape.
Exactly. And finally, if you're refinancing a VA loan to get a lower rate, you'll see the VA rate reduction certification, which just documents the old and new loans and confirms you're actually getting a better deal.
Okay, so it's all about making sure those changes are documented correctly.
Mm-hmm.
Now, Marylyn, we've talked about what happens if there are errors in the documents, but what if the actual terms of the loan change?
That's a good question. Sometimes after you've been approved for the loan and you've locked in that interest rate, things happen and the terms of the loan have to be adjusted.
Okay, like what kind of things? Give me an example.
Well, sometimes the appraisal comes back lower than expected. If that happens, the lender might ask you to make a bigger down payment, or they might lower the loan amount to match the appraised value.
That makes sense. They have to adjust things to manage the risk.
Right. Another common scenario is if the borrower's financial situation changes. Like maybe they lose their job or they take on some new debt, which affects their debt-to-income ratio.
Right. That ratio is really important for getting approved for a loan. So the lender might have to change the loan amount or the interest rate to account for that added risk.
Exactly. And sometimes the borrower is the one who wants to change things. Maybe they decide they actually want to borrow more money, or maybe they want to extend the length of the loan.
Interesting. So changes can come from the borrower, too.
Definitely. No matter who's making the changes, the important thing is that the borrower understands how those changes are going to affect their loan, their monthly payments, and how much it'll cost them overall.
Right. Even small adjustments can add up over time.
Absolutely. And if the loan terms change after you've locked in your interest rate, the lender is required to give you a revised loan estimate at least 3 business days before closing.
Okay, remind me what a loan estimate is again?
Sure. It's a document that lays out the main terms of the loan, like the interest rate, the loan amount, your monthly payment, and an estimate of the closing costs. You got one earlier on in the process, and this updated version will show those changes. You'll want to compare it to the original one and see how those changes are going to impact your costs and your monthly payments.
So it's another chance to make sure I'm good with the new terms before I actually commit to anything.
Exactly. Now, remember that security instrument we talked about earlier?
Yeah, we touched on it before. What else do we need to know about it?
Well, the security instrument, also known as a deed of trust or mortgage, is what creates a lien on your property. It gives the lender a legal claim to your property as collateral. It's a way to protect their investment in case you default on the loan. Basically, it says that if you can't repay the loan, the lender can take the property and sell it to get their money back. It's like the backbone of the whole mortgage system.
Okay, so this is serious business. It has some pretty big implications.
Absolutely. It's usually recorded with the local government, too. That way, there's a public record that the lender has a lien on the property, and anyone who's interested in buying the property or lending money against it will know about the mortgage. One of the most important parts of the security instrument is something called the power of sale clause. This gives the lender the right to sell the property if you default on the loan, and they can do it without having to go through a long, drawn-out court process.
Wow, that definitely makes things faster for the lender. But it also means that borrowers need to really understand what their rights and responsibilities are under the security instrument.
You're absolutely right. You need to know that if you fall behind on your payments, the lender has the legal right to take your property. And speaking of important rights, let's talk about that notice of right to cancel again. This document is so important, I can't stress it enough.
I think we're getting the message. It's a big deal.
It really is. It gives you, the borrower, 3 business days to cancel the loan after you sign. No penalties, no questions asked. This right applies to refinances and some other loans, but not when you're buying a property. It's meant to protect you from making a rash decision or feeling pressured into a loan you're not comfortable with.
So it's like a cooling off period where you can back out if you change your mind.
Yeah.
How do you actually cancel the loan if you decide to do that?
Easy. You just notify the lender in writing within that 3-day period. You don't even have to give a reason. If you cancel, the lender has to give you back any fees you've paid, and they have to release the lien on your property. And one thing to keep in mind is that those 3 days start on the day you sign the loan documents, not the day the loan is funded.
Okay, so pay close attention to that signing date. It can be easy to mix that up.
Exactly. All right, let's move on to those documents about payments and escrow, the payment letter, and the initial escrow account disclosure statement.
Okay, back to the nitty-gritty of actually making those payments every month.
The payment letter lays it all out. When your first payment is due, the grace period for late payments, how much those late fees are, what your payment options are, and how to reach customer service if you need help.
So it's like a little handbook for managing those mortgage payments.
You got it. And if you have an escrow account, you'll get that initial escrow account disclosure statement. This one gives you an estimate of the starting balance, how much you'll be paying into the account each month, and when they expect to pay out those property taxes and insurance premiums.
So it's like a sneak peek at how that escrow account is going to work throughout the year.
Precisely. Now, we've covered so much information, but I want to remind everyone that even though these documents might feel overwhelming, it's really important to take the time to understand them.
Right. It's my money, and I need to make sure everything is in order. Knowledge is power, especially when we're talking about a mortgage.
Exactly. The more you understand about these documents and the closing process, the more you can protect yourself and make smart choices. Don't be afraid to ask questions, get clarification, and speak up for what's best for you.
Great advice. It's my investment after all, and I want to make sure I'm doing everything right.
You got it. And remember, you're not alone in this. You can always ask a real estate attorney, a financial advisor, or your lender for help. Now, let's move on to our final segment. We'll wrap things up and give you some final tips for navigating the closing process with confidence.
All right, welcome back to our deep dive into those essential real estate loan documents. We've covered a lot of ground, deciphering everything from the cover sheet to all those tricky disclosures. But it doesn't just end there, right?
Yeah.
I mean, once you've signed those documents, what happens next?
Right. There are definitely some important things to remember even after you've signed on that dotted line and you've got the keys to your new home or you've got that refinance finalized.
Okay, so Marylyn, walk us through those next steps, those post-closing steps. What's the first thing I should expect after the closing's done?
Well, after everything's finalized at the closing and the loan is fully funded, that means the lender has actually sent the money over. You're going to get a complete loan package from the lender. This package will have copies of all those documents that you sign, and it's like your Bible for the loan.
So it's like the final confirmation that everything is official, everything's recorded.
Exactly. It's super important to take some time, maybe when you've got a quiet evening or a free afternoon, to really carefully review all those documents one last time. Make sure every number, every single date, every detail matches up perfectly with what you agreed to.
It's like my last chance to catch any errors or anything that's not right.
You got it. It's so much easier to fix things now than to try to deal with problems down the road. Once you've checked everything and you're happy with it, make sure to store those documents somewhere safe and where you can easily get to them. You never know when you might need them.
Right. I'm going to put mine with all my other important papers, like my insurance and stuff.
Good idea. So now that the loan is funded, it's time to start making those monthly payments.
The reality sets in.
But the good news is most lenders offer a lot of different ways you can pay. You can usually pay online, over the phone, or even just mail in a check.
So I don't have to rush to the post office with a check every month.
Hopefully not. You just have to find a payment method that works for you and stick with it. Being consistent is important. Those late payments can hurt your credit score, and no one wants that.
Definitely not. Now, we were talking about escrow accounts earlier. For those of us who have them, how does that work with making those monthly payments?
Good question. Basically, if you have an escrow account, the lender will handle paying your property taxes, your homeowner's insurance premiums, and any other things that are included in that escrow. You still make one payment to the lender every month, and then they'll take care of distributing those funds to cover those specific costs.
Oh, okay. So it's like they're handling all those bills for me.
Exactly. You'll get an annual statement from them that breaks down everything that happened in your escrow account so you can see how the money was used. And the best part is they'll adjust your monthly payments to make sure there's always enough in the escrow account to cover those expenses. No more surprise bills or trying to come up with a big lump sum payment.
That does sound pretty convenient. What happens if I need to contact the lender after closing? Like, say I'm thinking about selling the property or maybe refinancing to get a lower interest rate. How does that work?
That's a good point. In those situations, you'd need to ask the lender for a payoff quote. This statement will show you the exact amount you would need to pay to completely close out the loan, the remaining principal, the interest, any fees, everything.
Got it. So if I'm selling, I'll know exactly how much I owe to clear the title.
Exactly. Now, sometimes things happen, right? Life throws you a curveball, and you might run into some financial difficulties and have trouble making those mortgage payments.
Uh-oh, that's a scary thought.
It is a tough situation, but remember, you're not alone, and it's so important to communicate. As soon as you think you might have a problem making a payment, reach out to your lender. Don't wait until you've already missed payments.
So being proactive is really important, reaching out to them before things get out of hand.
Absolutely. Most lenders are actually willing to work with you if you're facing a hardship. They might offer things like a forbearance that lets you pause or reduce your payments for a little while, or even a loan modification, which means they adjust the terms of the loan to make the payments more affordable.
Okay, so there could be some options available if I just talk to them openly and honestly.
Exactly. And to make things easier, a lot of lenders have online portals these days. You can log in and see all your account info, your payment history, manage your escrow account. It's all in one place.
Oh, that's a great way to stay organized and on top of things. Any other final tips for us, Marylyn?
Just a couple. First, always pay attention to anything the lender sends you. Sometimes things change, like interest rates, loan terms, even the company that handles your loan. Staying informed can help you avoid any surprises.
Right. Keeping up with communication is important.
And lastly, just remember that when it comes to real estate and mortgages, knowledge is power. These loan documents might seem intimidating, but don't let them scare you off. Ask questions, get clarification on anything you don't understand, and make sure you're getting the best deal. The more you know, the more confident you'll be, and the better decisions you can make to protect your investment.
Such great advice, Marylyn. Thanks so much for walking us through These real estate loan documents, they can be confusing, but you've definitely made them a lot less intimidating.
My pleasure. And to our listener, congrats on starting this exciting journey. Whether you're buying a new home or refinancing to reach your financial goals, you've got this. Stay informed, stay curious, and never be afraid to ask questions.
That's a great way to wrap things up. Thanks for joining us for this deep dive, and we'll see you next time.